Hi, this video is a walkthrough video of the first AAT sample assessment for AQ 2016 of the Credit Management Unit. Okay, so let's start sharing. Right, okay, so where are we? Right, so 7 tasks altogether out of 150 marks, 2 of which are written tasks. The first few are very much sort of knowledge-based, drag the correct terms, match things up, true, false, that sort of thing. Right, so 1A, drag and drop the correct words into the following statement. Terms specifically stated in a contract are known as, right, so it's going to be express terms. So expressly stated as opposed to implied terms, which would just be, well, everyone assumes that to be the case. So terms specifically stated in the contract are known as express terms, which are binding for both parties. Terms that are fundamental to a contract are known as conditions. So fundamental means really important. Ones that are less fundamental, less important, are known as warranties, not to be confused with getting a warranty if something goes wrong. It's the same word but different context. If they are broken, the party breaking them will be in breach of contract and can be sued for damages. It's quite obvious. Right, Gustav owes Holst £25,000 excluding VAT, which is charged at the standard rate. The debt has been overdue for 90 days. The current base rate is 0.5%. What is the amount of interest that Holst may charge Gustav under the Late Payment of Commercial Debts Act? Calculate your answer to the nearest penny. Right, so the calculation I need to do here is the 25,000 plus the VAT. So I'm going to do 25,000 times 1.2, which gives me 30,000. And then I'm going to multiply that by 8.5% because it's 8 plus the base rate. So times 0.085 going into the calculator. And then it's for 90 days. So I'm going to multiply by 90, divide by 365. And that will give me my answer of 628.77 rounded to 2 decimal places, the nearest penny. Part C, identify whether the following statements about the Data Protection Act are true or false. So we know that we've got the 8 principles for the Data Protection Act. So just to recap, data must be held for a specific purpose for only the required amount of time. There's rules around the EU, right of access for data subjects, can't be disclosed without their consent. Business registered for the Data Protection Act has to register, it has to be held securely, and it has to be factual. So let's have a look at these points. Companies are able to find out what information is held about them on computer-based records. Right, that one is going to be false because it's companies. If it said individuals are able, then that would be true. But because it's companies, the Data Protection Act is about individuals, not about companies. Right, next one. Individuals have a right to object to decisions taken where there is no human involvement. that is true, then individuals cannot request that data relating to them will not be used for direct marketing purposes. So we've got a double negative there. So basically individuals are in control of their data, so it's false that they're not allowed to give that instruction. Data cannot be held for more than 6 months. Again, that's false. There is a rule about time, but it's just that it's a reasonable amount of time. If you still need the data, it can be held for longer than 6 months. Sanjay orders 500 sweaters from an online fashion supplier. The sweaters are described as 100% wool. When the sweaters arrive, Sanjay checks the labels and sees that the material is actually 50% wool, 50% man-made fibres. The contract between Sanjay and the fashion supplier is voidable. That means it was valid to begin with, but it can be made void due to. So I think it's fairly clear here that it's misrepresentation because the seller has lied about the content of the sweaters. And then E. Identify whether the following statements about consideration in contract law are true or false. Consideration has to be in the form of goods or money. Well, no, it can be anything of value, so that is going to be false. Consideration can be in the form of agreeing to perform an existing public duty. Well, no, because that wouldn't be consideration, you already have to do it. Consideration can be a promise to do something in the future. Yes, that's known as executory or executory, depending on how you want to pronounce it, something that is going to happen in the future. Right, task 2. 24 marks. So that first one was 18 marks, this one is 24. Now I think this is the easy question, 24 marks in the bag for knowing your ratios. Looks as if this question is always going to be presented in the same way. Floor Tiles Limited uses a credit rating system to assess the credit status of new customers. The credit rating scoring system below is used to assess the risk of default by calculating key indicators, comparing them to the table, and calculating an aggregate score. Right, so you look as if you're going to be given the scoring system for each of the ratios that you're going to be asked to calculate, and then working out what the total is to determine the risk of this particular business. It says here the sales department has asked for a credit limit of 45,000 to be given to Bathrooms Limited, a potential new customer. The financial information below has been supplied by Bathrooms. So we've got our profit and loss account and the statement of financial position. We've then been asked to calculate the various indicators and then convert them into a rating. In the exam, by clicking on each of these, you will be able to move it sort of out to the side so that it's not conflicting with your screen. It's just because I'm on a laptop here, I can't really demonstrate that very easily. But nonetheless, let me try. Right, so I've got my two statements there. And then the first thing that I'm being asked for is the operating profit margin. Right, so the operating profit margin is going to be my operating profit. I'll just do the X5 figures because obviously it just gets repetitive otherwise. So the operating profit margin is going to be the 483 divided by the 9870 and times 100. Make sure you look and see what the required level of accuracy is, so 2 decimal places. So that gives me 4.89%. Personally, I would just work out all the figures first and then do the ratings, but it's up to you which way around you do it. My interest cover, so that's going to be my operating profit or loss, divide by my finance costs, not times 100 this time because the measurement is 2.42 times. Our profit covers our interest 2.42 times, whereas that top one is a percentage. Current ratio then, coming to the statement of financial position. So you need your current assets, which is 561 for the year X5, divide by your current liabilities. Now watch out here, they haven't given you a subtotal of the current liabilities. So you're going to have to add together the 110 and the 356. Right, so altogether I've got 561 divide by 466, which gives me an answer of 1.20 to the nearest 2 decimal places. Right, then gearing. So gearing is a measure of how much of the total finance comes from debt. Remember, in the credit management exam, debt will be all of your borrowing, not just the non-current liability figure. So here we're going to have to do the 2,000 plus the 110. So 2,110 divide by the sum of 2,110 plus our equity, that 1964. Again, it's a percentage, so times it by 100, which gives me 51.79. Now, one thing to point out here, which is important, and I'm just going to try and flick to the answers for a moment to show you this. This box here. The model answer uses the appropriate negative figures for negative operating profit margin percentages and zeros for negative interest cover figures. They do go on to say that for the assessment you can do other things, but I would recommend that we just stick with this. So if you work one out, and for example, the 20x4 operating profit percentage comes to minus 1.46%. So if you're dealing with a loss, you're dealing with an operating loss margin, I suppose, then you put in the negative figure. Conversely, when you work out the interest cover for 20x4, because interest cover is measuring how many times the profit covers the interest, if you've got a loss, it just doesn't. So therefore, it makes more sense to put 0 in that instance. Okay, so I'm not going to go through and sort of fill them all in, but that sort of gives you a taste. So the top one there should be minus 1.46, and then the interest cover just 0 like that. And you will go to the credit rating system, and you basically convert everything. So our operating profit margin here, 4.89, so less than 5%, so that gives us a rating of 0. Interest cover, 2.42, so 2 and above, but less than 4, so that would give us 0. Current ratio, so we need to move over. So what have we got? 1.20, so this one. So minus 10 for our current ratio. And then our gearing, 51. So 50% above, but less than 65. That's giving us a score of 0 there. So overall, minus 10. Right, so if I just close those all down for a minute. So if I had worked this all through in its entirety, these are the answers that I would have obtained. And I would have had ratings of -5, just using that conversion table, -30, -10, and 10, giving a total there of -35. Right, so then the final part of this question is to use this table to decide what rating we are going to give Bathrooms Limited. So I have just calculated that we've got -10, -35. So if I go back up, I should have left that one open, never mind. So -10 gives me medium risk, and -35 is high risk. All right, so previous year it was high risk and now it's medium risk. So then you just come to here and you convert as appropriate. So what have we got? Medium risk current year and high risk previous year. So the correct answer is request latest management accounts and defer decision. Okay, so I think that task is pretty straightforward. Right, we then come to task 3. Right, so 30 marks, and this is your first of 2 written questions. So Milan Limited has been approached by a potential new customer, Berlin Limited, asking for a credit limit of £50,000. Milan has standard terms of trade of 30 days. The sales director has advised that she has been invited. The sales director has advised you that she has invited the directors of Berlin Limited to play golf next month, as she is keen to gain Berlin Limited's business. The sales director receives a bonus based on the amount of new business she brings in. So part A, explain 3 sources of external information you could use other than financial statements when assessing whether to grant credit to a new customer. Now, you have access to the suggested answers. But what I wanted to do here is really sort of say, well, what would be realistic in terms of the exam? So you can see that it's 6 marks. It's 3 sources of external information. So obviously you're looking at 2 marks for each one that you mention. So pretty much it's going to be a mark to state it and then a mark for some sort of brief explanation thereof. So 3 external sources. So bank references is going to be my first one. So bank references. And if I was doing this in an exam, I would, so that's my 1 mark for stating it. And then I would say, these are reliable, has come from the bank, but banks word their response very carefully. They have to read between the lines as to the true meaning. Something like that. The second one would be trade references. So I'd get a mark for saying trade references. So this is where the new customer is asked to provide references from their existing suppliers problem here could be that they will only give the names and details of those suppliers they know will give a good reference. And then the third one that I think would be sort of the most obvious to do would be a credit agency. So these organisations maintain databases of information, so detailed information, such as payment history, bankruptcy proceedings, etc. The problem is that they may be out of date or sometimes relate to the wrong individual or business. Right, so realistically, that's what my full answer would look like. It doesn't need to look like their sample answer. I will just pull up their sample answer to show you the comparison. So here we are, model answer. So you can see they've been very helpful here now, actually, giving us where the marks are likely to be allocated. And again, you can see, you're asked to write about 3, but there's, even just amongst these first 3, there's 1, 2, 3, 4, 5, they've given sort of 3 possible marks for each one, and you only need 2. And you certainly don't need to write about options 4 and 5. They run either or, right, to get those 6 marks. Right, we then come to the next part of the question. Explain the role of the sales director in the credit assessment process. Right, well, we saw in the introduction that the sales director is very keen. She's keen to gain their business. She receives a bonus based on the amount of new business she brings in. So there's definite conflict of interest there. So yes, she can bring in the business, but she should really have no role in the credit assessment process. So the sales director should not be involved in the credit assessment process. Right, so you're going to get a mark for acknowledging that, and then a mark for some kind of explanation because it's 2 marks, because there is a conflict of interest whereby she is keen to get the business as she will gain a bonus payment. I'll just say something like that. Again, if I look at their suggested answer, much more wordy, but we're looking for 2 marks. They've said in the sales director's role is primarily sales driven and she may be influenced by the fact that she receives a bonus based on the amount of new business. I'd be happy that I was going to pick up that mark from what I've written there. Right, then we move on. Berlin Limited has supplied the following information based on the last 2 years of trading. Right, so we have their statement of financial position, statement of profit or loss, and a number of ratios that have been calculated year on year. The following additional information has also been provided. Berlin Limited sells catering supplies, but also hires out larger equipment and machinery. Berlin Limited is planning to make a significant acquisition of non-current assets under long-term leases. a bit nasty. I mean, for us it's okay because we've done our financial statements unit. And hopefully we remember that a right of use asset under a long-term lease is where even if we don't technically own the asset, we are recognising the asset in our statement of financial position and then the corresponding liability for the lease. The lease commitments will be non-cancelable. That means you can't get out of it. Details of planned commitments from 20x6 are shown below. Right, explain 3 factors for each of the following that may affect the decision on whether or not to grant credit. Use the information from the scenario to support your answer. Now, I've looked at this sample assessment and the second one, and they are very similar in style and layout. Now, I can't obviously guarantee that that's going to be the same in the real exam, but it's looking likely that your exam question will be in this format. So they have broken it down for us into profitability for 6 marks, liquidity for 6 marks, and gearing and risk for 6 marks, and asking for 3 factors. Now, I have prepared a separate document, which I've already put on the team, basically giving you a writing frame to approach this style of question. So for profitability, I have suggested that you sort of remember that your 3 points, your 3 factors are going to be some sort of statement explanation around revenue, some sort of statement and explanation around gross profit, and that's the actual gross profit figure and the margin, and then the same for operating profit and margin. Right, so again, you've got the AAT sample answer here, which, you know, is very good, but let's just pull out what we think would be sort of good enough in the exam to get us these 6 marks. Right, so first of all, turnover. So a statement about what's happened. So turnover has decreased by 3.5%. So you could put in a calculation there. It is difficult to say the reason for this, possibly just a small downturn in the market or arrival of a new competitor. Right, so your first point will be something about turnover, a statement of what has happened to it, and then some sort of explanation. So in this one, there's no real explanation. They haven't given us any clues why the turnover has decreased. You know, you could say that. You could go back to maybe we've had to reduce the price because of the competitor. You know, there's any number of reasons why this might have happened. So you can just make a couple of suggestions. Right, then my next point will be around gross profit. So, and I am using their answer to sort of help me a little bit here. So the gross profit has fallen by, I'm not going to say fallen, I'm going to say has, no, that's fine actually. So it has fallen by 3.1%. So a similar trend to the turnover. What's happened to the gross profit margin? Let's have a quick look. So the gross profit margin is basically consistent. However, the gross profit margin has remained constant at, oh, I've forgotten what the number was already, 21%. I would say close to 21%. Right, so we've made our statement. So is there anything else to really say here? Overall, this is consistent with the previous year. So there doesn't seem to have been any change in turnover or cost of sales. It's not particularly exciting, but following this kind of writing frame approach, so 2 points on turnover, 2 points on gross profit, and then 2 points on operating profit. So the operating profit, so what happened to our operating profit figure? Let's have a look. So looking at the profit, statement of profit or loss. So operating profit, so that has declined. Again, you could work out the percentage increase. I'm just going to say for now by, I haven't got my calculator here, so 820 take away 50 is 770, so I'll just use the absolute term for a change. The operating profit has fallen by £770. And now I'm looking for the ratio. So, and the operating profit margin on this one has changed, look, from 9.6 to 7.2. And the operating profit margin has worsened by, so they've done that one as a percentage, so we could just, by 25% since the previous year. Right, so if I know that my gross profit margin had stayed the same, but my operating profit margin has worsened, that tells me that the problem is in the overheads. So this suggests that increased overheads. And let's have a look. So if we go up to the statement of profit or loss, distribution costs have increased and the admin also has increased. So is there any sort of particular sort of reason for that, given the clues in the question? Sales is planning to make a significant acquisition. So I'm just looking at their suggested answers. So they've said here, this fall may be because Berlin has changed its method of distributing equipment as distribution costs have increased. All right, so nothing too exciting. So we could just say distribution and admin costs have increased, which is perhaps surprising, as these are would normally be linked. Wait a minute. I'm going to say distribution costs have increased, which is surprising, as these would normally be linked to sales, which have fallen. Admin costs have increased, which is surprising as these would normally be fixed. Right, so just maybe sort of thinking about the cost behaviour a little bit there as well. Now that's probably what I would do exam-wise. Again, their answer, you only got 6 marks altogether. They've talked as well about interest cover, but you've only been asked to explain 3 factors. So going into the exam, if you're thinking turnover, gross profit, operating profit as the 3 things that you would speak about here. Right, we then come to liquidity, where we're going to follow a similar approach. So the 3 things to talk about this time, if it were me, I would do the current ratio analysis, receivable collection days analysis, and payable payment period analysis. As an alternative, you could choose inventory days, but I just find the others easier to talk about, so that's what I would do if it was my exam. So I would start with the current ratio. So the current ratio is, and then we would have a look. So what's happened to the current ratio? Right, it's gone from 0.7 to 1.1, so that's better. Better than the previous year, suggesting that liquidity has improved and the business is now better able to pay its debts as they fall due. We could analyse that a little bit further. We could look at the figures that make up the current ratio. So looking at the statement of financial position. So what has really happened? Well, we've got much less inventories, a little less trade receivables, same amount of cash. So seems to be the inventories that's caused the difference. And then current liabilities, a drop in trade payables, and a big drop in borrowing. So main reason seems to be inventories have gone down, but that has been more than compensated for by the change in trade payables and borrowing. So I'll probably just make some comment to that effect. So although the inventories have fallen in value, this is more than compensated for by the decrease in trade payables and borrowing. Right, and then leave a gap. Paragraphs, make it clear to the examiner, you're on to the next bit now. So then, as I said, I would do the receivables collection period and have a look and see what's happened to that. So the receivables collection period has gone from 33 to 31, so it's improved slightly. Has improved slightly from 33 to 31 days on average for customers to pay their debts. This shows the company is managing its debt collection well. 30 days is a usual credit terms period, and the company is close to this. Something like that. Again, please do review their answer as well, but this is just sort of trying to show you, you know, like what you might actually write that would be realistic to write in an exam situation. And then the third paragraph, the payables payment period has, and then you look and see what's happened to it. So payables, right, so that's gone from 42 to 35. So they're paying their suppliers more quickly, 42 to 35. Has improved from 42 to 35 days on average to pay their suppliers. This shows the company has good working capital management and is able to pay their suppliers on a timely basis, so maintaining good relations with them. As with trade receivables, 30 days is a usual credit terms period, and they are now close to this timescale, like that. I'm just going to go and grab my power cable because I'm running low on batteries. Okay, so then we come to the next box, which is gearing and risk, and again 6 marks. So here my 3 points. Has it asked you? Explain, yeah, so explain 3 factors. So you've still got to do your 3 factors. So here my 3 points that I would recommend would be 1, to talk about the gearing percentage analysis. 2, to talk about the finance risk of the business. And 3, to talk about the business risk. Right, so I'll try and show you what I mean. So the gearing has improved from 77.8% to 47.3% in the current year. Also mentioned what's happened with the borrowing. So this shows that less of the company's finance now comes from loans compared with shares. Looking at the absolute figures, so the actual figures rather than just the margins, the level of borrowing has reduced substantially from 12.7 million to 4.3 million. So this is a good sign. Right, so that's my first paragraph talking about the gearing percentage. Right, then we want to think about the finance risk. So what is this company actually doing? So if we are loath to keep going up and down because it's changing the size all the time, but basically with this business, there has been a substantial reduction in non-current assets. Let's just go up and look at the figures for that. So non-current assets, look, property, plant and equipment has gone from 15,473 down to 8,399. Right, so maybe they have been sold off to generate some cash to basically repay some of the debt. But they are planning to make a significant acquisition of non-current assets under long-term leases. So what that means is, yes, we're going to get the assets back, but we're also going to have this debt in the form of leases, right? Which is obviously going to increase our gearing again, because the debt for the leases is basically a form of borrowing. We're also told that these lease commitments are non-cancelable. So that is going to increase our business risk. Right, so this is probably the most difficult bit that we've come across. But let's try and just break it down. So financially, the company has recently sold off a large proportion of its non-current assets, possibly to reduce its loans. However, it is now planning to acquire more assets under non-cancelable leases. This will increase the gearing risk once more. Right, so we're basically saying it's come down in that first paragraph, which is a good sign. However, it's got these plans to invest again. So, you know, we're going to be back to where we started. So that's kind of thinking about the finance risk. Maybe you could add in why it's a risk. So high gearing is risky because the company has finance that requires servicing in the way of interest and repayments. So business risk, from a business risk point of view, perspective, the company needs to have assets, non-current assets, because this is its main function. So there doesn't seem to be any way around the high gearing situation unless it were able to sell more shares to fund asset acquisition. Right, so try to keep in your mind, talk about the gearing, talk about the finance risk, talk about the business risk. Right, then we come to the final box, which says recommend whether or not credit should be granted. Support your recommendation with 3 reasons. Now, again, I'm a sort of big fan in trying to sort of think ahead, you know, how are you going to structure your answer? So you're going to have 1 mark for your recommendation. And then you've basically got to make 3 statements to get your 3 supporting marks. So looking at their suggested answer, it actually says a decision on granting credit should be deferred until after suitable discussions with Berlin Limited. I always think that's such a cop-out. I think really you should be saying yes or no. But anyway, this particular exam, they seem happy with a sit on the fence recommendation. So I'm just going to put here make recommendation. So you make your recommendation as to whether you think it's a yes or a no, as to whether or not you're going to grant them that credit. So we just sort of have a quick reminder of what we've said. So turnover and gross profit margin seems okay. A little bit of an issue with their cost control. Liquidity, pretty good. The only real problem we have is the gearing. So how should you summarize this? Well, you'll be looking at 3 sort of statements. So the first one will be on profitability. So profitability margins. No, hang on, what should we say? So some concern over operating profit margins linked to higher distribution and admin costs. Right, so I mean, again, I would probably go as far as to have spaces between each point so they can really clearly see, like, that's 1 mark, that's 1 mark, that's 1 mark. In terms of liquidity indicators are positive, demonstrating good working capital management. Main concern is the high gearing, which is likely to return once leases are entered into. Right, so a profitability comment, a liquidity comment, a gearing comment, or a risk comment. Other things that you could include, so that would be 3 points that I've made there. Other things you could include would be a reference to how much credit they want relative to the payables or the turnover. And something that they've put into both of the AAT suggested answers is that if credit is granted, further comfort in the way of retention of title clauses, credit insurance, or directors' guarantees might be considered. So personally, I would just add that in, unless it's a no-brainer that it's absolutely a wonderful company to grant credit to. So maybe write your statements first, and then come and make your recommendation. Personally, I can see where they're coming from. I would probably have gone with, yeah, give them credit. Credit should be granted, assuming comforts can be obtained. Something like that. As I said, they've said should be deferred until after suitable discussions with Berlin Limited. Right, so that is your big written question. As I have said, there is more guidance in the writing frame, but I just wanted to show you here how I would apply that to this particular question. Right, we then come to task 4. So another one around knowledge of your ratios. So very time consuming, but I don't think particularly difficult. So the sales department of Rosemary Limited has asked for a credit limit of £55,000 to be given to Time Limited, who is a potential new customer. The financial information below has been supplied by Time Limited in respect of the last 2 years. Rosemary Limited trades on 30-day terms. So then you've been given the profit or loss and the statement of financial position. And then you basically have to go through and complete this. So turnover has increased by, so if we're looking for a percentage increase, and the way to do any percentage increase is to find the difference. So do 17,500 subtract 12,400 and then divide that difference by your starting point. So here your starting point was 12,400. So 17,500 minus 12,400, divide that answer by 12,400 and times it by 100, which should have given you this answer here. Gross profit margin, so just a straight calculation of a gross profit margin, gross profit divided by sales revenue. For 20x4, and for 20x5. Operating profit in itself has increased by, so another percentage change. However, the operating profit margin in X5 was, so an operating profit margin, operating profit divided by turnover. Compared to same calculation in X4. So basically saying gross profit margin in X4 has fallen. Operating profit margin has actually improved. So this tells us that the expenses must have been well controlled because they've like clawed back some of the problem in the gross profit margin. Although there might be some signs of possible over trading, 40% increase in turnover, which needs to be investigated further. Interest can be covered. So interest cover calculation, operating profit divided by interest. If we do that for both years, we get 6 point something, so over 6 times in both years. Liquidity. Both the current ratio and the quick ratio have, so work these out, and I got the current ratio, I got 1.4 compared with 1.6 in the previous year. And then the quick ratio, I've got 0.8 compared with 0.95 in the previous year, so it has deteriorated. In order to understand the liquidity position further, it is important to review the trade cycles and the individual components making up the ratios. Inventory has increased by, right, so that's another percentage change calculation, the difference over the starting point times 100. When compared to the increase in turnover, this might indicate that time is planning further increases in sales. The inventory holding period has increased from, so inventory holding is the inventory divided by cost of sales multiplied by 365. So we just work those two figures out. As I said, very time consuming, but not that difficult. This means that, so inventory holding period has increased, so we're holding it for longer. So basically we've got our funds tied up in inventory, we're holding it for longer. The trade receivables collection period has, so I calculated both of these and I got 79 last year, 59, no, other way around, 79 this year, 59 last year. So it has worsened by over 20 days. Trade receivables have increased by, so another percentage change calculation, and it works out this time as 90.91%. This might mean that, so trade receivables has worsened, so it's not more effective. Maybe they're just selling more and they've forgotten about collecting the money. The payables payment period is, so I worked this out and I got 97 days. So can't remember what they told us about our thing, but let's have a look. Did it tell us anything about that? Oh, 30-day terms. So significantly more, if it's working out as 97, than our standard terms of trade. The company has no cash and is more reliant on short-term borrowing. So recommendation, it's not looking too clever, so we refuse credit. Okay, on to task 5. Match each type of claim on the left to the appropriate type of court procedure on the right by clicking on the left box first and then on the corresponding right box. Right. Okay, so over £25,000 is the multi-track. It can be either the High Court or the County Court. The County Court is less important than the High Court. So over 25,000, getting complex, it could go either of those routes. If it's under 10,000, we are on the small claims track. The small claims track is going to be in the lesser important court, the County Court. And then in between, that's the one that we talk about, the fast track. It's not magistrates because that's criminal law. So County Court under the fast track. Which of the following statements are true if a retention of title claim is to be successfully enforced? The goods subject to the clause must be clearly identifiable, yes. Goods which have been altered cannot usually be repossessed, yes. The goods subject to the clause must be in the customer's warehouse. No, that's false. It could be somewhere else. It could be in their factory, for example. There must be a retention of title clause on every invoice. Again, that's false. As long as it's in the contract, it doesn't have to be shown on every invoice. XYZ is considering alternative ways of managing debt collection. XYZ's total receivables ledger balance as at 30th of June X5 is 2560, which includes 180,000 of debts over 90 days. ABC can provide XYZ, because a lot of letters here, isn't there, with a facility whereby ABC manages the receivables ledger on behalf of XYZ. ABC will lend XYZ a maximum of 1750 or 75,000 of the outstanding receivables balance, excluding debts over 90 days. ABC will not provide any protection against irrecoverable debts. Right, so ABC is offering, so will not provide any protection against irrecoverable debts. So that means that there is, hang on, ABC is the company, isn't it? Right. So that means there is comeback. So there is recourse. It is known as factoring, where the sales ledger is being managed. Invoice discounting is literally just buying the debt. So a recourse factoring facility. How much can they borrow? So it's a maximum of either 1750 or 75% of the outstanding receivables. So if we do 2560, subtract the 180, and then find 75% of that, it gives us 1785. So it's a maximum of either 1750 or this. So we're going to be capped at the 1750. Next question. Which of the following are stages in a company winding up procedure? Right, so we know that a statutory demand is issued. We know that the court is petitioned. If you go back to that PowerPoint, and I went through this, these terms are all on there. There's not going to be a bankruptcy order because that is for sole traders and individuals. This is a company. And there's not going to be an appointment of an administrator because going into administration is a different thing from winding up. So the correct answer will be those two. Drag and drop. An aged receivables, did I put that back to, yeah, there we go. An aged receivables analysis is a management tool that can be used to highlight customers who are slow to pay. It analyzes the balance due from each customer according to the age or the date of each invoice outstanding. Analysis of trade receivables can also be undertaken based on focusing attention, this is that 80-20 rule, so not many of the customers, 20%, which make up 80% of the total value of outstanding debts. And the last one on this task, Christopher owes Jane $7,500 for goods supplied. What is the normal remedy for Jane as a result of non-payment of the debt? So the main one that we'd always use would be action for the price, which is where the court orders you to make the payment. Task 6. 16 marks. So DEF wishes to claim VAT bad debt relief on some unpaid customer invoices. True or false? So we know the rules for reclaiming VAT is that the debt has to be at least 6 months overdue and it has to have been written off in the accounts. So must have already accounted for the VAT and paid it over. Well, obviously, if you're claiming it back, you must have paid it in the first place. The claim must be made within 3 years. Well, yes, but the actual rule is 4.5 years. So, assuming that's the way they want the question answered. DEF must have made a provision for the unpaid debt. Well, it's not just a provision, it has to be written off. The debt must have remained unpaid for 6 months after the due date of payment. Yes. Meerkat Limited wishes to offer a 2% discount to its customers for settlement of invoices within 21 days. Meerkat's standard terms are 45 days. Right, here comes the big formula. The simple annual cost of the discount. Right, the simple. So that's the formula where it goes D divided by 100 minus D times 365 divided by N minus capital D times 100. So putting this one in, I'm going to do 2 divided by 98 times 365 divide by 24, 24 being 45 minus 21, and then times by 100 to 2 decimal places. That gives me 31.04. The compound annual cost of discount, this is the more tricky formula. So the formula where you do 1 plus D divided by 100 minus D, raised to the power of 365 over capital N minus capital D, and then minus 1 times 100. So this is the one you've really got to practice with your scientific calculator. Make sure that you can do that correctly. So we're doing 1 plus 2 divided by 98 raised to the power of 365 divided by 24 minus 1 times 100. If anyone's having problems with that, let me know by sending me a message. Which one of the following is an important aspect of liquidity management? Having enough assets to meet all obligations on a timely basis. Well, it's not all assets, it's current assets. So I'm not going to tick that one. If it's which one, we'll come back to it if we need to. Being able to pay all suppliers and operational costs as they fall due. Yeah, I'm confident it's that. That one it's nothing to do with because it's profitable, and profit and liquid management are different things, and loan repayments is nothing to do with it. Jonty's customers currently pay 30 days after the month end. He is introducing a 1% discount for month 2 if customers settle the invoice in the same month. It is expected that 80% of customers will take advantage of this. The expected sales revenue per month is as follows. So expected cash receipts in month 3 will be, so 80% of 136,000, and then times that by 99%. That gave me 107,712. And then I would get 20%, the ones that didn't take advantage in month 2, so 20% of 105,000 with no discount. So that gives me 21,000. Add that together and we get 128,712. Which one of the following is not a type of credit insurance? So key account is when you insure certain accounts. Catastrophe, we came across. Unlimited excess. That doesn't make sense because the excess is the amount you pay yourself. And that doesn't make sense. Whereas whole turnover is where you're covering all possible irrecoverable debts. Tom has received a letter from the liquidator of Jerry. The liquidator has indicated that all unsecured creditors of Jerry will receive a dividend of 2.5p in the pound later in the year. Tom is owed 7,500. Calculate the amount that Tom should write off as an irrecoverable debt. show your answer to the nearest penny. So we just do 7,500 times 0.975. And that's going to be our bad debt, 7312.50. And then we come, last but not least, to our final written question. So 20 marks on this one. So this question is all about what do you do when someone isn't paying you? So Soft Fruit Limited manufactures and supplies computer components. It also assembles and supplies computers made to individual customer specifications. VAT is charged at the standard rate on all supplies. Soft Fruit Limited includes all monies retention of title clause as part of its standard terms of trade. Computers that are custom made to a specific customer order carry a unique serial number for warranty purposes. Payment terms are 30 days. Soft Fruit Limited has credit insurance for certain named customer accounts. You work in the credit control department of Soft Fruit. Your supervisor is away on holiday and is not contactable. However, you have been provided with the information below. Today's date is the 30th of June. Review the specific customer information below with a view to recovering the outstanding debt. State the amount of any allowances or write-off of irrecoverable debts, claims for credit insurance, and VAT bad debt relief where applicable. For each of Soft Fruit's customers, recommend one possible option to recover the outstanding debt. Support your recommendation with 4 reasons or comments. So, customer 1. FDP is a regular customer of Soft Fruit Limited and always pays to terms. FDP is responsible for 15% of Soft Fruit Limited's annual turnover. Right, so immediately we know this is a big, important customer. FDP has ordered 12 custom-built computers for use in a new software development project. The order had specified that all 12 computers were to be delivered by the 16th of April in time for the project to begin. Soft Fruit Limited delivered 6 computers on the 15th of April. However, due to the extended illness of their computer engineer, Soft Fruit Limited could only deliver the remaining 6 computers on the 25th of April. The total value of the invoice dated 25th of April is $72,000 including VAT. FDP has complained about the late delivery, stating this has significantly delayed their important project. They are withholding payment and asking for compensation. So my immediate thoughts is the customer's right here. I mean, you've supplied late, so they're a big important customer. I think I would be eating humble pie and sort of trying to grovel as appropriate. So one recommendation: arrange to meet FDP and negotiate a suitable discount to recognise the late delivery of the computers. It's only asking for one recommendation. Again, I'm looking at their suggested answer with where the marks would be. They have said it would be preferable to meet with FDP and negotiate some kind of discount for the problems and inconvenience caused. 1 mark. That's all you need. Right, and then your reasons and comments. 2 secs. Aaron, you can get what you need. I'm only just doing a video. About another 5-10 minutes. So 4 marks. So again, space out your answers so that the examiner can easily give you those 4 marks. So we need to make a point that they are a big, important customer. So we don't want to upset them. You can make toast. Okay. So we could review the documentation, although we probably know what that's going to say, to ensure who is in the right, to use as a basis for negotiations. So if delivery was late, then FDP have a valid claim for damages for breach of contract. It would be preferable to avoid this and come to some agreed discount. Main aim is to maintain customer goodwill so that they will order again in the future. It would not be wise to proceed down the path of following exact credit control procedures in this instance. Right, that's what I would do if I was in the exam, something like that, showing where the 4 clear points are. It would be worth your while reviewing their suggested comments. I've got them in front of me here. 1, 2, 3. They've actually got 6 possible marks available. You've got to get 4 of them. Right, let's move on to number 2, gigabits. Softfruit Limited has received notification that Gigabit is in receivership. The amount of the outstanding debt is 28,620, including VAT. The receiver has told Softfruit Limited that she will not accept any retention of title claim, as the goods in question are generic computer components that Gigabit has purchased from a number of suppliers. It will therefore not be possible to identify which had been supplied by Softfruit Limited. The account is credit insured for a maximum of 75% of the net debt, or 15,000, whichever is the lower. Can we just go back up here for a minute? I think they're lying because, oh, that's computers, a unique serial number. What's this one for? These are components, so maybe they're not separately identifiable, but we should probably pursue that a little more in any case. Now, there's only 1 mark available for the recommendation. I've got the suggested answer from the exam board in front of me, and there's 5 possible things you can say here, but there's only 1 mark available. I would probably go with the claim on the credit insurance. A claim should be made on credit insurance for 15,000. And then you could show in brackets the calculation. So they had a debt of 28,620. That was net figure, so that comes to, sorry, that was the total figure, so the net figure is 23,850 times 75% was the insurance, which is 17,887.50. Insurance is capped at 15,000, so this is the amount that can be claimed. Now, their suggested answer sort of looks like that would be 2 marks, but I would probably do that just to be on the safe side. They've also talked about other alternatives, which would be making an allowance or provision, reclaiming the VAT, contacting the receiver. But then it does kind of make the reasons and comments a bit difficult, but I think, again, looking at their suggested answer, it's okay to talk about facts relating to the recommendations that you chose not to make. If that makes sense. So I might say something here like, although the receiver has said the parts are not identifiable, it would be worth paying a visit to the premises to check that this is in fact the case, because the receiver will be acting in the interests of the fixed charge holder. Remember, a fixed charge is where someone has lent money to the business against security of a specific asset. So a typical example, there might be a mortgage. So that would be one reason or comment. What else could we say? There's a good point here in their suggested answer, the fact that it's an all monies retention clause. It says this means it would not be necessary to match any goods unpaid to specific outstanding invoices. So it's a bit more general. So as it is an all monies retention of title clause, this means that it is unnecessary to match the specific goods to the specific invoice. So it is possible that other goods supplied by, what's the name of this company again? Soft Fruits, could be located so that's a good point. If the retention of title clause is not enforceable, Soft Fruits would be an unsecured creditor and would be unlikely to get much money. And then I would probably stick in once the debt is more than 6 months overdue, an amount of, I haven't calculated it in advance. Oh, wait a minute, they've done it here. It works out to be 4770. The VAT can be reclaimed from HMRC, making sure I've got 4 specific points. Right, third customer, Natintra, has an outstanding invoice for 15,000 including VAT. The invoice is dated 1st of March. Netintra has been slow to pay in the past and has now given several excuses to delay payment, ranging from being unable to trace any of the original documentation to the authorised cheque signatory being away. Soft Fruit Limited has supplied Netintra with copies of all relevant documentation and, in accordance with the credit control policy, is now about to instruct a debt collection agency or commence legal action. The HR Director has asked you to refrain from sending the debt collectors or instructing solicitors because the Managing Director of Netintra is President of the local tennis club. She wishes to join this club and she is concerned that any unpleasant tension will affect her application. Right, recommendation. Do not listen to the HR Director as she has a conflict of interest as she wishes to join the tennis club where the Managing Director of Netintra is President. Right, so I think that's the most obvious thing jumping out there. I'm just having a look at their suggested answer. The HR Director's personal situation should have no bearing on Soft Fruit Limited's business decisions, and she should not use her position as a director to influence how a policy should be applied for her personal gain. They've also given a mark if you said Soft Fruit Limited should proceed to instruct a debt collection agency or commence legal action. Right, reasons and comments. So let's go back to the company itself. So a variety of excuses have been provided. It appears the necessary documentation is available to prove the validity of the debt. It is substantially overdue, more than 90 days old. There is no business reason not to take legal action, which should now be put in place. I could add here, attempts have been made by Soft Fruits to discuss the matter. Okay, so just make sure you get 4 points in. Right, and then the very last part of this task seems to be very straightforward. It's basically a sales ledger control account, level 2 style. So Soft Fruit Limited has had some problems with certain customer accounts following a computer virus. The accounts department has managed to recover the following details relating to the account of Megachips. And it's given you a whole load of information and asked you to calculate the payments received from Megachips in the month of May and in the month of June. So it's not asking for the closing balance, it's asking us to calculate the payments received. Perhaps saying level 2 was a slight injustice, more like level 3 where you had to do incomplete records. Now, it's very awkward because you can't use the tab key on these exams, and then it's asking you for 2 months. So I'm just using the space bar to sort of try and do some kind of table, which I think is going to be your best bet. So the opening balance in May, 65,000. If we then do the invoices, so we've got for May, we've got 22,000 net of VAT. So again, I would show the examiner as much as possible. So 22,000 times 1.2 to add the VAT on is 26,400 is owed. Credit notes, that is including that, so 3840, and I'll put that in brackets to show that it's being subtracted. Late payment charge in May, so late payment charge, so that's going to be 250 added on. And then it tells me the closing balance. So if it's given me the closing balance, so it's saying debit. So that means balance. So the opening balance is a debit. If the closing balance is a debit, that means that the carry down is basically the opposite of the opening balance, right? So the carry down must be a credit. So therefore I have to subtract that closing balance to be able to work out the missing payments received figure. And the similarities here with the working that you had to do for the cash flow statement in the financial statements unit. And then June, so we're starting with our closing balance of 37,600 debit. We've got our invoices. You see what I'm doing here with this table situation. So this one includes VAT, so 16,920. And the credit note, this one includes VAT, 2,100. Coming off, there's no, oh yeah, oh, there's no late payment for that month. And then the closing balance this time, it says is credit. That means the carry down is a debit, which means it's going in I just looked at the suggested answers and realised that I've put that round the wrong way. So balance at the 31st of May, 37,600 debit. It's a bit confusing. I thought that meant that the balance was a debit, but I need a calculator. So 65, that's going to be 80 odd. No, I think I've laid that out correctly. Why aren't they? I'll check this in a minute. I think it's okay. I don't have a calculator to hand, which gives us the payments received for June must be 54,520. 37, let's use the calculator one here, hang on. Let's make sure I've got this right. Right, so let's just check the maths here. So I've got 65,000 plus sorry, plus 26,400 minus 3,840 plus 250 minus 37,600 equals, yeah, is correct. Okie doke. So that concludes the paper. I hope you found it useful.